Hello, everyone, and welcome to this session where we'll be discussing an introduction to accounting. After going through this session, you're expected to have obtained an understanding on the following: the accounting cycle, the different types of source documents, the books of original entry, the general ledger, the accounting equation, the trial balance, as well as the different types of financial statements. Just to provide a brief background to accounting, so accounting is essentially made up of three main activities, which are: one, identifying those events that are evidence of economic activity, that is transactions, relevant to the particular business or entity. Then two, the recording of the monetary value of the transactions. So recording involves keeping a chronological diary of measured events in an orderly and systematic fashion. And three, the communication of the recorded information to interested users through the preparation and distribution of accounting reports known as financial statements. So, with regards to the accounting cycle, this just provides a flow of accounting activities in an entity. So, when transactions happen, the description and the monetary value of the transaction are recorded on a source document. So the source documents information then is then taken to be recorded onto the books of first entry, which are the journals. Then the journal totals would then be transferred to the general ledger accounts. Then the general ledger account balances in terms of real accounts, then the amounts that you close off the general ledger with for nominal accounts will all then be transferred to be presented onto the trial balance. So the trial balance would then be made up of a list of general ledger accounts. Then that information on the trial balance would then be utilized to be presented on the financial statements. So with regards to transactions, when you're looking at a transaction, for example, if you are in business and you are operating a business whereby you are selling stationery, your transactions will involve activities such as going to buy the inventory either for cash or credit from your suppliers, then you being able to sell those stationery items to your customers either for credit or for cash basis. Then also you can have returns by your customers as well as returns that you can also make to your suppliers. Then you also have operational activities such as you also paying for your water and electricity as well as your salaries and wages. So all these are examples of transactions, and this is not an exhaustive list. There's quite a lot of transaction examples that we can think of. So when transactions occur, then the description of those transactions and the monetary value of that, for proof that these transactions have taken place, that information needs to be recorded on source documents. So source document examples are cash slips, invoices, credit notes. So when you look at cash slips, we are looking mainly at cash transactions whenever we are buying for cash or we are actually selling for cash. So if you go to the shop and you buy, be it milk, and you're given a till slip, that's a cash slip. If you are buying on credit, you get given an invoice. If you're selling on credit, you issue the invoice. If you make returns, you get given a credit note. If you are the ones, uh, uh, your customer is making some returns, you also issue the credit note to the customer. Then you also have EFTs and petty cash vouchers as well as the check. So this is also not an exhaustive list, just an example of the various source documents we have. So now, with regards to the information that's on the source documents, we then go on to record that in the books of original entry. So here now, these are the journals whereby the source document transactions of a similar nature are recorded. So examples of journals include your sales or debtors journal, whereby we record credit sales. Then creditors journals or purchases journals, we record credit purchases. Then cash receipts journal, we record cash receipts transactions. Then cash payments journals, we record cash payments transactions. Then whenever there are returns by customers, we record them in the debtors allowance journal. Then whenever we make returns to our suppliers and creditors, we record that in our creditors allowance journal. So once we have recorded all items of similar nature in our journals, the journal totals now would then need to be transferred to the general ledger. So in here now, at this stage, that's when we introduce the concept of double entry. So a general ledger account is made up of a debit side and a credit side. So there are two types of general ledger accounts, that is nominal accounts and real accounts. So in terms of nominal accounts, they start each new fiscal year or financial year with a zero balance, while a real account starts with the ending balance from the prior period. So real accounts carry forward to the next financial year, while nominal accounts get posted to profit and loss. So with regards to the double entry concept, this is a key principle in accounting because the double entry concept stipulates that for every debit, that is the left hand side entry, there should be a corresponding credit side entry for the same amount. This means that you should record each transaction in at least two accounts. So this then brings us to the accounting equation. So the accounting equation is a fundamental principle in accounting that wants to show that whenever we have assets, those assets, they need to have corresponding equity and liabilities that would have financed them. Meaning that this accounting equation needs to balance all the time. Unless we are looking at a position whereby we are insolvent, whereby we now have a lot of liabilities, but we do not have any assets to show for them. So the accounting equation, this is the perfect explanation of the double entry concept, as every time we post items to the ledger, it needs to maintain a balance, meaning that the assets need to equal the equity and liabilities. So what are assets? So assets are the income generating items of the entity. That is, in layman's terms, is the tree. So the asset itself is the tree, whereas the fruit is the income. So in the context of a business, let's say a building, the building is an asset. Then if you're going to be renting out the building, the income that you are generating will then be the rental, right? Then liabilities are the financial obligations the entity has or the money the entity owes other institutions. For example, creditors, accrued expenses, loans, all those are examples of liabilities. Then, owner's equity are the funds that the owner injects into the business, as well as the profits retained by the entity for reinvestment. So now, with regards to the trial balance, so the trial balance is a list of all the general ledger accounts of a business at a specific period of time. This list will contain the name of each ledger account and the value of that ledger account balance. The accounts reflected on a trial balance are related to all major accounting items, including assets, liabilities, equity, revenues, and expenses. So the total of the debit column needs to match the total of the credit column. That is, it needs to balance. So a trial balance needs to balance all the time. So in a nutshell, assets and expenses, you have debit balances, whereas equity, liabilities, and your incomes, you have credit balances. So now this brings us to financial statements. So we use the trial balance for the sake of preparing our financial statements. So financial statements are the reports that provide the detail of the entity's financial information, including assets, liabilities, equities, incomes, and expenses, shareholders' equities, cash flow, and other related information as at a specific period of time. Examples of financial statements are statement of profit or loss and other comprehensive income, statement of financial position, which can also be called the balance sheet. The names keep changing so many times, right? Over the years, they have actually changed. So sometimes you notice that they use balance sheet interchangeably with the statement of financial position. Then we have statement of cash flows, statement of changes in equity. Those are the main ones that we'll be looking at. So now, having covered the introduction to accounting, we just want to have a little mind teaser just to reflect on the aspects that we've covered thus far. So just a small example here. Can you name any three source documents? One. Then two, can you name any three books of original entry? That is the journals. Then three, is the revenue or sales account a nominal or real account? And four, is capital account a nominal or real account? Yes. So just to provide the answers to close this off, here are the answers. Right, so three source documents we can look at. Here we just put in cash slip, invoice, credit note, but this is not only the source documents you can also identify. I'm sure you've identified others other than this. Then also the three books of original entry. Here we've included sales or debtors journal, purchases or creditors journal, as well as the cash receipts journal. I'm sure you may have included others such as your cash payments journal or your debtors allowances journals as well. Then is the revenue account or is the revenue account a nominal or real account? Then here it's our answer here is just that it's a nominal account. Then the capital account, is it a nominal or real account? So capital account is a real account because you can carry it forward to the next year, and the balance it started with from it carried from the prior period, it continues with it into the and following year as well. So yes, this was just an overview of accounting. I hope this session was helpful. Looking forward to continue working on this into the next session on accounting. Thank you for your time.